everybody. Welcome back, and we're going to answer the long-awaited updated video, 5 questions you need to ask when getting quoted mortgage loan rates. Now, you might be saying, George, what the heck? Why is this so important? Why do you keep dwelling on this? Because, hey, listen, we try to help you make the best business decision possible. And by doing that, you get to save thousands of dollars a year, and sometimes up to $10,000 a year understanding rate, because there's nothing more frustrating than getting down to the day of closing and all of a sudden you realize, holy mackerel, look at all these fees to get the rate that I got. Ugh, what the heck? And this way, you're going to be able to compare an apple with an apple. See, now, if I was super technical, I would show an apple on the screen, but nonetheless, I don't do that. So here we go. Let's get this show on the road. But more importantly, remember, subscribe, share, and like. I like to say it backwards because it's different. Why? Because I'm different. The key is share this information. If you know somebody's looking at buying or selling right now, share this information. It's free. There's no marketing. And the best part is, if you want to save money, this is how you do it. All right, let's get the show on the road here. Look at that. 5 questions that you must ask when getting quoted loan rates. And you might say, okay, so let's do this. Let's dive into this. We're going to give you some examples. We're going to go through a little bit about what to keep in mind at each step. So the first one, compare rates at the same time and day. And you might say, why? Because remember, the feds have nothing to do with mortgage rates. They may affect it, but they have nothing to do with mortgage rates. Feds deal with car loans, credit card interest rates. In other words, what banks lend from a day-to-day into each other, okay? Plus they affect HELOCs, home equity line of credits. You need to watch mortgage-backed securities. You need to watch your bonds. You need to watch your 10-year treasury, because the stock market is very much like mortgage rates because they adjust every day. The stock in the morning might be different than it is 2 hours later, than it might be at lunchtime, what it might be at the point of close. As we know, it just goes all over the place, right? Watch my previous videos and we talk about what's going on with mortgage interest rates. So understand, if you're going to get quoted a rate, you have to do it at the same time of day. If you quote one in the morning and one in the afternoon, they could be completely different. Okay, now you're not comparing apples to apples. You're comparing 2 different things altogether. All right. Now, next one. Is there a discount point? Or it should say, are there any discounts? What's a discount? That is the cost to buy that down. They may say, well, you know, like one of the examples, you can see there's a 0.85% fee. Okay, well, 1% or 1 point equals 1%. So if you have $100,000 of a mortgage balance, right? 1% is $1,000. If you have $1 million, 1% is $10,000. When they say there are 2 discount points and you have $1 million loan balance, that's $20,000. Keep that in mind. What is that repayment cost? It might make sense, but in many circumstances, it does not. So if you didn't know about that and you got quoted this amazing rate and you go, wow, that's an amazing rate. You might look at that and say, cool. Then you get down to anything and it goes, whoa, wow, what do you mean $20,000 to get that loan? That's not what I meant, but it's too late at that point, and that takes away from your ability to look at other options. All right, what is the loan to value? That means what is the loan value to the appraised value of a property. If we have a piece of property that is appraised at $1 million, okay, and they say you need to have a 20% down payment or a 40, in one of the examples, you have to have 40% down payment. If you have $1 million, that means you put $400,000 down. Most people would say, whoa, I don't have $400,000 put down. I can do 20%. I can do $200,000. Well, that's fine. You just don't qualify for that loan program. Now you're in with everybody else. So understand, if you don't meet the criteria, all of this criteria, you don't qualify for that loan program. Super important to understand. When we take a look at the next one, what type of loan is it? So, are they quoting conventional mortgage? Is it a jumbo? Is it FHA? Is it VA? Is it a USDA loan? Because they're all different. And in fact, you may be a first-time home buyer, and they'll say, hey, we're going to offer this really unique program to first-time home buyers, and we're only going to, we're going to say you're going to get a 6.25% rate, and but your loan balance is going to be $350,000. Or if you're in our area where the median price is roughly about $800,000, and unless you have a ton of down payment, then you wouldn't be doing FHA financing, right? That doesn't make sense unless you're buying something lower on the spectrum, which in our area is a little bit harder. You might say, well, George, that could be a condo. Hey, just remember we have add-ons. We'll talk about that. Next one is credit score. Not what you get online with, Credit Karma and some of these other companies. And I'm not saying that they're not a good company to keep track of kind of the general, 60,000, foot mark. But banks look at a different type of credit report. They look at a tri-report that is definitely not at the 60,000. They're at the 5,000, the 3,000 foot mark, because they really hone it in. And it is called a hard pull. And it is very specific. And those credit scores many times are inconsistent with what you would see on these online systems. So keep that in mind as you're looking at things. Also remember, there are different levels of a credit report score, because remember, credit and interest rates are tied together because it's based on risk. All right. Okay, let's get our show on the road here. Let's take a look at a quick example. So here we've got, and note, this is for King County only. Only King County. If you're in Snohomish County, this doesn't apply. Now, what is super important about this as you're looking at the rates, you say, hey, okay, yeah, these are pretty good rates. Yeah, compared to today, par pricing is, 6.8%, 6.9, it's 6.5%. That's really good. And there you go. You get to see there's a discount point, right? Third of a point. Well, shade over that. But look at the bottom. The bottom is super important. Remember we talked about time? Well, look at that. It's at 9:17 a.m. Central Standard Time. Wow. And a very specific date. Why? Because they can change without notice, right? Let's take a look at this one. This is just a standard. They just sent this over. Look, hey, you get a primary loan at 6.125. Well, holy smokes, wait a second. When I come back here, this rate says 6.5. But yet over here, they say 6.125. So note that they don't give any other information. Why? This is called marketing. It's to get you to call. It's to get you to get online and make applications so they can sell you other products. Why? Because that program right there actually requires a minimum of 50% down. And the cost to get to that loan, I think, is like 3.5 points or some crazy number, right? I think it's 3.5 points, 2 points, 3.5 points. Anyway, nonetheless, you don't realize until you get into it, right? And it's super crazy. Let's take a look at another example here. Look, we have our 30-year fixed, 6.25. You think, hey, that's better than the 6.5. But time out. Wait a second. When you take a look at that, if you're looking at the jumbos, not only can you not, you have to have basically, less than $1 million, right? Plus, you have to put 25% down. Plus, you need to have a minimum of 760 credit score. Okay, well, let's say you're going to go FHA. Well, the maximum you can have then is $470,000 loan. Well, we just talked about the fact that our median price in this area is actually closer to 800. It's like 798,000. Well, okay, so if you need me to get that down, why would I go FHA? So you see, again, they are called marketing to get you to call. Make sure that you're looking at the details, because again, if you don't fit into that criteria, you don't get that loan. You get to go where the average person goes. That's all there is to it. They create niche programs with super tight criteria to, well, really, if you meet that criteria, then they're like, okay, this is a really good borrower. Well, no kidding. 25% down, 760 credit scores. Okay. How can a bank lose? Remember, it's based on risk. Well, they can't. That's why they make those criteria. They make them so tight so they can upsell you later. Okay. All right. Moving on. We take a look at this example. Okay. This is just a standard screenshot of what somebody would be looking at if you went online to say, hey, I want to get a loan quote. Well, look at that. their default price is at $300,000, 20% down. Not that many people buying at $300,000, or basically that would be $360,000 property, right? And a credit score above 700. And you can see how then they will break out the different costs. Why, you might ask? That is a great question to ask. Why? Because it is also based on a number of other factors. So your mortgage rates that you're going to look at, okay, is going to depend, is it a single family home? As you can see here, what am I doing? I'm buying a new home versus, well, wait a second, George, you said it differentiates. What if I'm doing a refinance? Well, there's an add-on there. You see, new money, new purchase money has best rates. A refinance, historically, well, they have higher rates. They have an add-on, right? And what if I'm pulling cash out? I got a lot of equity, right? As we discussed earlier, equity has a zero value until you sell the item or you collateralize it. Collateralize it by getting a loan. I'm going to pull money out of my house. Maybe I'm going to buy a car. Maybe I'm going to buy an investment property. Maybe I'm going to reinvest with it. Probably not today's interest rates. Maybe I'm going to pay off debt, right? The banks look at that as risk. You're pulling money out. Why are you pulling money out? Well, because I want the money. Well, I'm going to charge you for it. So now there's a secondary add-on. So now you're looking at these prices that you're seeing quoted online. And you're like, wait, they're not even close. Based on risk. What are you doing? Okay, let's take a look at our next one. Next step is, what kind of investment is it? Is it a single family home they're going to land on? That's the safest investment. Maybe it's a condo. Whoop, add on, a little more risk. Maybe it's multifamily. Whoop, add on, more risk. Why? More people subject to the single family. You take care of it yourself. Multifamily, a lot of different people, or an investment even. Not as safe, riskier. Interest rates goes up. Pretty simple. It's kind of like the next one. Primary residence, right? Secondary home or investment property, boop, add-ons. So understand that just because you're getting quoted a rate here doesn't mean that's what you're going to get. Depending on where you fit, everything is either based on credit score, what it is, down payment. Are you guys getting the gist of this? So you need to make sure. Now, granted, most of you are looking at single family home purchases. That's fine. If you're doing a condo, boop, add-on. Just understand it's going to be different. Don't be surprised, right? So when we hit our next one, are you a first-time home buyer? Believe it or not, first-time home buyers are definitely a riskier investment. Why? They're new. They're not used to it. They have no history. It's like credit. You have no history. And in order to create history, you have to have experience. First-time home buyers don't have that experience. So they're a little bit of an add-on, right? Okay, we talked about credit score. Look, it's based on risk. The higher your credit score, the lower the cost. Okay, with the lower your credit score, the higher the cost. That's why if you're interested in saving dollars, work on getting your credit score where it needs to be. That is above 680, preferably above 740. That is a really good credit score. And then you go from there. All right. We talk about different items. Okay. Employment does hold a significant impact, including, yes, immigration status. Okay. If you are a higher risk for immigration, meaning that, you might lose your job. Boop, you got to leave the country within 3 days. Well, that's a bit of a risk, and you get to pay that in rate. Okay. When we talk about if you're self-employed versus W-2, they say self-employed people have a higher risk, which I find humorous, but nonetheless, they have a higher risk versus W-2. They just don't understand they are self-employed, but to somebody else. Anyway, nonetheless, they look at them differently, and you get different credit interest rate reports regardless of where you are in some of the income levels of your own business, right? Okay, let's take a look at this. When we let's pop that open real quick. Oop, that didn't work. Let's try that again. There we go. Here we go. Typical, hey, I'm going to make a purchase versus a refinance. They talk about par pricing. Then they start running down what the cost is, right? And as you're looking at this, you're like, hey, George, that's not too bad. Look at that. 2 points, $5,500. Well, if you do the math, $5,500, that's basically about a $350,000 house, okay? Which is, again, pretty nominal. But when you see what the rates are and what they start to offer, then we go in and we take a look at what we have. Actually, they said this is based on $250,000 on mortgage. My math went the wrong way. But look at that. You have to have 60% loan to value. That's 40% down. Holy smokes. And you are not taking cash out, as you see on the right-hand side, that it is a single-family home, and that closing costs would be paid up front, not rolled into the loan. Why? Because it's risk. They want to make sure you have money. It costs more to roll all of those fees into a loan, right? That your debt-to-income ratios are below 43%, and you have a 740 credit score. Again, these are the questions you need to ask so that you know that you fit into these programs. If you don't have 40% to put down, you don't fit in that program. You need to find out what program you do fit in and then start getting those numbers. And remember, because you cannot secure an interest rate lock until you have a signed purchase and sale agreement, you need to make sure that you are getting your quotes updated all the time. Morning, afternoon, whatever it might be. If you're looking at bidding on a piece of property, get your quote. And if you don't get an answer until, you're not, hey, we're going to answer, at 9 p.m. tonight, get a quote at the end of the day, because that is what you're going to look at. Keep those things in mind as you're also negotiating so that you are, not hanging your fanny out there. Now, when we take a look at this, these are other disclosures, right? They talk about a $456,000 loan, minimum 25% down, finance charges of 0.8. Just understand, okay? These kinds of things are what you need to look at. This is what they look like, all right? Why is that important? Because if you are making a business decision, and many times it gets a little tight towards the end there, you need to make sure that you're getting what you are expecting. And as you're, dialing everything in with that lender, if you do not know this and you don't understand what a settlement statement looks like, and the costs, you may be wasting tens of thousands of dollars every single year. Keep this in mind. Super free information. Again, 5 questions. Make sure that you're comparing the rate at the same time and day, right? Are there any discount points? What is the cost of the loan? What is the value, or what is the loan to value that you need to make? How much of a down payment am I going to have, right? What are the loan types? Is this a conventional? Is this FHA, VA, USDA? What is it? Is it a jumbo? You need to make sure that you're in there, because if you're getting jumbo pricing and you're not a jumbo loan, meaning over, I think it's $970,000, you don't qualify. It's a different loan program. Okay, you fit in the conforming, different, right? And then of course, what is the credit score minimums? These are questions that you must ask in order to make sure that you understand the full picture of every single loan program. And with that, remember, smash that subscribe button. Share this with people that you know. Hope you guys enjoyed the information. Ask questions. We'll also post a link for the 3 preferred lenders that share the same professional and ethical standards that we do. There's no cost, there's no obligation. Feel free to ask them questions as you like. And in the meantime, I will see you on the next video. Have a great day. Take care.